President Trump has made big strides that are very pro-crypto. It's got to be great for somebody like you. However, the price of, let's just say, Bitcoin, which reached a high after the election of something like $107,000, is nowhere near that now. I think we're around 86,000 and change, but it's been a market drop. When do you foresee this moving back up? Because we've seen all kinds of wild projections of something like $250,000 per Bitcoin by the end of this year, to people who say this thing's going down.
Yeah. When I think about that, your last guest, Larry Fink, talked about just taking the long-term view.
Right.
And I almost don't think about it in that kind of short-term time frame. I think about what are the macro trends playing out for the crypto industry, for the XRP ecosystem. XRP has been the best performing major crypto in the last 90 days. We think about it as, what does that look like over the next 3 years? I'm very optimistic. I mean, Ripple just announced our largest acquisition, actually one of the largest acquisitions in the entire crypto industry to date. We announced it earlier this week on Tuesday, in the middle of tariff palooza. I don't know exactly what's going to happen with the tariffs, but we're betting on where the world's going to be in 3 years, not what's going to happen in the next 6 months.
Would you have made that acquisition a year ago?
No, hard no. Look, the SEC in the United States and even other parts of the Biden administration, it was a coordinated attack across many different agencies. Mm-hmm. We're finding that more and more out now. You already highlighted it in your introduction. The IRS had hostile rules about crypto that really didn't make any sense. Banks weren't even allowed to reasonably custody crypto without having an equal offset to their balance sheet, which really makes no sense for a bank than to even partake in this industry. It's a real industry. That administration wasn't listening to consumers. They weren't listening to the voter and what the voter wanted. We're now seeing a significant change across the board. And an acquisition like that would have made no sense a year ago, and it makes a lot of sense now.
I mean, even Larry Fink said on this network, on this show about a year ago, that it was a hedge against cratering currencies of whoever's country. That hasn't quite come into play. The dollar has been falling really precipitously over the past 5-6 days. In fact, it was continuing, at least as of this morning. It had a 3-year low against the euro and a 10-year low against the Swiss franc. And crypto, at least today, is moving higher, but it moves all over the place. Yeah. What drives the price of crypto?
I wish I had a clean answer to that question. Like any market, a lot of factors drive that. There was a period of time as some of the tariff dynamics were playing out where crypto was clearly outperforming the equity markets. But, some people expected it to perform more like gold, where you're seeing all-time highs. I think people are still figuring out how that'll play out. I think the long-term value here is going to be very clear. It is a hedge against inflation. It is a dynamic where the more utility we drive in the crypto markets, the more we're going to see value accrete to that market.
I don't know if you do this, but I'm going to ask you anyway and push you. What is your price target for Bitcoin? Because Cardano blockchain founder predicted, as I said earlier, 250,000 by year end.
I will predict Bitcoin. I wouldn't predict XRP. It's too close to home. But I think 200,000 is not unreasonable. I think before I've kind of said, 175 around there. I think people underestimate how the largest economy in the world, the United States, went from headwinds, hostility, to tailwinds. And I think people are still not fully quantifying how significant that is to have the largest economy in the world, the largest asset managers in the world go from relatively frozen out or hostile to now a friendly market that has sensible regulation that is thinking about pro-innovation here at home.
Right now, because we're effectively embargoing $439 billion in goods from China, we're going to experience what could end up being the highest inflation in ages in our country. It's hard to disagree with that assessment. And I say that as someone who generally supports a trade crackdown on the Chinese government. At the end of the day, China is the low-cost producer. We need other countries to stand up and make the goods for us, or we need to build automated factories at home to do the same thing, because wages in America are simply just too expensive to compete. But either way, that transition is going to take some time. And in the interim, we're going to either need to pay through the nose for this stuff or suffer through shortages. I expect both. I want companies with no cyclicality because with the battle of inflation we're about to have, the economy is in real trouble. Unless a second China surfaces out of nowhere, the Fed won't be able to help because of the tsunami of government-ordered inflation. I'll let you know when I find an extra 1.5 billion people, but until then, we are in trouble. There's a reason why China owns so much of our retail market. Their stuff is cheaper and just good enough that few American companies are willing to take them on. They knew how to price their stuff to discourage our own entrepreneurs.
China raising its tariff on U.S. goods now to 125%. It says it no longer will match U.S. tariff increases because at this point, American imports aren't marketable at these levels, calling it a, quote, joke. Eunice Yoon joins us this morning on the ground in Beijing. What is the latest?
It's not funny, though.
Thanks, Andrew. So these new tariffs are going to go into effect in 6 hours' time. And as you were suggesting, the language around this decision is really interesting. The Chinese Commerce Ministry had called these tariffs abnormally high. They said that they were a joke. And the argument is that at these levels, Chinese people wouldn't even be able to buy some of these American goods or wouldn't want to buy American products. So the ministry went on to say that if the United States continues to play the numbers game of tariffs, then China will ignore it. So instead, the focus has been on how to support Chinese exporters from President Trump's 145% tariffs. And it looks as though the government is also marshaling some support from the private sector. Today, JD said that it's going to buy $27.3 billion worth of Chinese exports this year to sell into the Chinese market. Alibaba, its grocery chain, Hema, is going to be fast-tracking exporters to sell into the China market. And then we also saw some support for Chinese companies that want to use American tech, because the Semiconductor Industry Association defined what it means by a U.S. chip. So a U.S. chip, if it's designed in the U.S., but then it's taped out or basically turned into a chip elsewhere, then those ones would not be subject to a tariff by the Chinese.
Because we see China, or the administration sees China, as the existential threat, and they've been circumventing these things. We need to stop that. And so when we talk about what the goals are, I think the goals are lower oil, lower rates, putting China in a box, and having fair trade or balanced trade in North America between the EU and parts of Asia, and then we can move forward from there.
But when you got the number of 145% on China, your reaction was what?
They don't want to do business with China. They want to put as much pressure on China as they will. They know that she will not bend, and that's really the purpose. We want to slow down their economy as fast as possible.
Yeah, but if you try and slow down their economy, you're hurting our economy at the same time.
No doubt about it.
We need more stuff from them than they need from us.
It's not so, but if you're making progress elsewhere, that's a good thing. Eventually, what I think is we'll get to some reasonable middle level, but the point is you want to put as much pressure on them as possible because it has to be extreme, right? They will not, they're in a position where they've dug in, we've dug in, and it's got to be a lot of pressure. And what we're going to do is we're going to release that pressure by doing, or what I think we're going to do is we're going to release that pressure by doing deals with other parts of Asia, across North America, and in the EU. And what we want to do is we want to put China, or what I think they want to do is they want to put China in a box, which creates more pressure.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you join the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And also, guys, make sure you go like and follow the TikTok. More videos to come. And we have Brad Garlinghouse speaking on the crypto market. And we know the crypto market has 4-year cycles with the Fed printing money. And once we get stablecoin regulation, they'll be able to mint trillions with a push of a button. And remember, the Crypto Teacher told you. And we have the dollar falling, and I told you a long time ago, the dollar is going to fall. We're going to a level playing field. But right now, crypto is falling because the Fed is shrinking liquidity. And we see stocks and cryptos are taking a hit. And then we also know the legacy market has to be broken up. We're in a fragmented world. It has to be destroyed in order for the fourth industrial revolution to rise. And that's the robots, algorithms, and drones, blockchain, and these digital assets. And remember, the crypto teacher told you. And we have Brad Garlinghouse on a Bitcoin prediction. Says that Bitcoin could easily hit 200,000 this year. And we know we don't pay attention to predictions. We follow the Fed. And remember, the crypto teacher told you. And we have Jim Cramer on China. Says the prices are going to be going up. Supply of goods are going to start shrinking. And then he also talked about automated factories. And we have China with this 125% tariff. And instead of sending the goods to us, they're going to distribute it to their people. And don't forget, guys, their poverty is about to move up to the middle class due to the fourth industrial revolution. And remember, the crypto teacher told you. And we have CNBC says that Trump doesn't want to do business with China. And guys, we know China and the U.S. are going to collide. I have it in the NWO book. I talked about it all the time. Remember, guys, I told you it's a plan. It moves in phases, and we're finally here. And you know I brought you plenty of videos of Anthony Sutton mapping out the plan back in the 80s, and we're finally here. We know exactly when the drums are about to beat, and we know exactly the reason why, and that's this digital economy. Every drums are beating was to move us over to an agenda. This time it's going to be the fourth industrial revolution. And we have David on CNBC says countries are running away from the dollar when normally they run to the dollar. And we know all these stable coins are not going to help. The United States dollar is going to lose that world reserve currency, but still hold a little power just because the dollar is going digital. And these tariffs are being used to change the trading structure. And we can clearly see that the supply chain is being changed right in front of our eyes. And tariffs are just a disguise. They're just creating the two sides. Like Charles Hoskinson said in the first video, they're just creating the two sides. Some countries going with the U.S., some countries are going with China. We already seen it with the Belt and Road, but that is definitely going to weaken the dollar. And remember, the crypto teacher told you. And nobody wants this long-term paper except for the Fed. And I've been saying that over and over and over again. Now we're starting to see it. Nobody wants the United States long-term paper because they know what's about to happen. The fall of America to Babylon. And the key question is, will China start to sell more U.S. treasuries and U.S. mortgage-backed securities? If they do, we know we're in trouble. And remember, guys, they need that crisis in order to bring in all this technology. And we know the Fed could fix the problem tomorrow, but we know the Fed is always late on purpose. And remember, the crypto teacher told you. They cause a problem, wait for the reaction, and run in with the solution. And we know that solution is that free money in the metaverse. And remember, the crypto teacher told you. And we have PPI number come out today. Of course, it's still sticky. And they never add in the things that we buy on a daily basis because we know prices just keep going up. And remember, the crypto teacher told you. And we have BlackRock's Larry Fink says that we better not slow up on AI because China is not. And we know BlackRock's Larry Fink is the hidden hand on building this fourth industrial revolution. They want the machines to run the economy without a human involved. And remember, the crypto teacher told you. Because he knows when it comes to the NWO, it's all planned out. Y'all have a wonderful day.
Of this week are significant in terms of the falling dollar, rising bond yields, and so forth, or no?
I think they're very significant, Kelly. I mean, this is a highly unusual risk-off period where the dollar weakens and bond yields rise, or at least don't move significantly. They obviously moved a lot lower and then came almost all the way back, so they didn't offset equities like they usually do. But the weaker dollar is a really different phenomenon. In most of the crises where these types of funding facilities would come in that Steve was just talking about, they're almost always in an environment where people are running for the safety of the dollar. And you know what? This is maybe worth thinking about. The only other one that we've seen was in October of 22 with the LDI crisis with the UK, where we've seen the long end have some issues like it's having, largely because the marginal buyer is a leveraged buyer, and there's risks of trade battle-related selling from our trading partners. So I think the facilities aren't 100% set up exactly in the past for a weaker dollar risk-off scenario, which is probably confusing the markets a little and maybe even confusing the Fed and Treasury.
Thought this morning, the swap lines are to borrow dollars when dollars are short.
Absolutely.
And I tried to run through my brain, could the Fed borrow euros? I mean, they are, by the way, bidirectional.
It's
they
like
can
when
go both ways.
We made the LNG export terminals. Or the import terminals. We had to flip around and make them export terminals.
It's same idea. I don't know, David.
So I don't think that's. I don't think that would be the way I would think about it. I think the way I would think about it is the currency policy is probably largely going to be set by the administration and the Treasury Department. That's not the Fed's lane. And really, Steve, what I think we're seeing, and what I've been arguing with, speaking to our clients about this past week, is there is a cogent effort to kind of take down the mercantilist trading structures that have been in place for many decades. That's what this last week was about. And part of that involves likely a weakening of the dollar. So I don't know that you want to be changing that. You want to do that in a way that doesn't completely disrupt the bond market or trading partners who have amassed large amounts of dollar securities, which is a difficult needle to thread, no doubt. I don't think we're 100% in that heat of the battle in the trade war where it gets there, but we should have the facilities there to make sure that something like that doesn't happen. And I imagine that has been discussed because it did happen in the UK.
But would you have clients buying bonds here, 10-year, 30-year bonds? I mean, I almost see this cascading effect where just the U.S. is going to buy the debt. Maybe it's a mini stimulus plan that can benefit from the interest. It replaces foreign buyers if, in fact, they are going to vanish. But that's only going to be the case if the concerns that we have about inflation and the deficit that Mike just outlined are not going to remain front and center.
I don't see people running, racing to buy treasuries. Not at this point, no.
All right.
Not at all. If the stock, your favorite stock, Microsoft, Apple, whichever it is down 10%, 20%, and you can convert that stock in kind from a traditional IRA to a Roth, as the stock reappreciates in the Roth IRA, you've been able to sneak tax-free value over to the Roth IRA, so it helps to offset the tax cost of doing the conversion. So that's one of the principal ones that I'm working on right now. But apart from that, it's just if you have some stocks that have done pretty well, utilities or things like that sort of help buttress your portfolio, you have an opportunity to rebalance. That's a responsible thing to do right now. When you see asset prices drop sort of in concert, sort of a synchronized downturn in all asset classes, they can't all be priced correctly. So you find the ones that you know that have the better chance of having earnings growth in the future, and you buy them. And the other ones that you sold, you're likely to do better.
A reasonable question that people are asking is whether China will exercise that nuclear option. Earlier we talked about how China's holdings in treasuries is huge, $760 billion. If China were to, sell just a part of it, that could be massive implications on the market. How are you assessing that risk?
We watch that risk very carefully. Unfortunately, it's difficult to get our hands on that data in the near term. So we watch, patterns and timing of selling in the treasury market for indications. But we have a sense that it's really a combination of multiple factors at work against the U.S. Treasury market here, particularly at the long end. Yes, China could be stepping back. They could be, posting significant sales. We could also see other countries around the world opting to pare back their exposures or participate less in the U.S., as you said, as they look for alternatives. And the alternatives are there now. You can see attractive yields in other markets that give folks optionality rather than simply focusing on the U.S. But in turn, I do think that risk premium and assessment for how much you need to be paid to own the 10 and the 30-year is also very, very real. So I see it as a combination of factors more so than simply the action of China.
What it may look like if China were to sell its holdings of treasuries. It holds, of course, almost 10% of all the total treasuries held by international investors. How might this play out?
It would play out likely with a continued steepening of the curve, but I've also read that a good amount of their holdings are at the shorter end of the curve, so we would have to see some action there as well. But it's really a pretty dramatic step for China to do that. I'm not saying it's impossible, but again, I think markets here are searching for levels to price in a variety of issues. The tariff announcements that were made last week and then somewhat pulled back on midweek, were very significant and I think set the world on edge. If what we're trying to do is reorder how nations trade and what they do, there's so much to consider. And even behaviors of our companies. Are they going to, begin to lay off workers? Are they going to slow down investment? Is the consumer going to respond? I think the habits and tendencies here will really be extraordinarily challenging to predict.
Inflation equation, and they're big numbers, down 0.4 on headline, down 0.4. That would be equal to where we were in October of 23. And if we find a lower number, you're going all the way back to April of 2020 in the COVID-affected era, and that was down 1.2%. Now let's strip out food and energy, down 0.1%. That equals where we were in February. It equals where we were in July. To find a lower number, you're in April of 2020.
There's no peak. There's no, right. In fact, the capex that's necessary to do that is only going to grow. As we democratize AI, we need more data centers because the utilization will be greater. So this is
it is, but the costs are going to go up, aren't they, conceivably, for the servers that go into a data center?
Right now, a 1 gigawatt data center with all the GPUs, all the power, all that, we're talking $50 billion per data center.
Right.
We're talking major. But data centers don't throw off a big return. So a data center throws off, even with leverage, because at 11 or 14% return.
But that's fine for you're happy to finance it all day long.
But that's the beauty of our capital markets. Microsoft trades at a much higher PE.
Right.
Owning data center degrades their PE. Same thing with
they don't want to. They'd much rather have you and pay you, and they're a great
power of our capital markets.
All understood. But does it? This has been the most important thing we've been talking about for the last year and a half, 2 years. Has been driving a lot of our certainly our equity markets. Do we slow down our advances as a result of some of these tariffs that are in place right now?
We better not, because China's not slowing down in their technology.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction.